All right, let's talk about money. Every business on the planet, whether it's a tiny corner store or a massive company, has to answer one huge question. Where is the money going? Today, we're going to pull back the curtain on the simple but super powerful tool they all use to figure that out. It's called the ledger, and we're going to see exactly how it keeps score of every single penny. Okay, let's bring this down to earth. Picture this. You're the go-to snack person for your friends. How on earth do you remember who paid for what? Who still owes you for that soda? Are you scribbling it on a napkin, trying to keep track in a chaotic group chat? Yeah, it gets messy fast. Well, that super common, kind of annoying problem, that's exactly what a ledger was invented to solve.
So here's what we're going to do. First, we'll dig into that money tracking problem. Then, we'll introduce its solution, the ledger. We'll take a look under the hood at its anatomy, learn the two simple rules that make the whole thing work, try it out ourselves, and then we'll see why this thing is still so important.
And that brings us right to our first stop, the money tracking problem. It really doesn't matter if you're a huge corporation or just selling lemonade on the corner. The challenge is exactly the same. You've got to have a solid way to know what you've got, what people owe you, and what you owe other people. I mean, let's be real. Our memories are terrible when it comes to money. Did Sarah pay you back for that coffee? Did you pay that phone bill last month? When it's just small stuff, it's just annoying. But for a business, it's a total disaster. You just can't run a business on memory. You absolutely need a system. And that's where the ledger comes in. This is it, the original time-tested answer to that whole money tracking headache. Seriously, long before we had spreadsheets or fancy software, we had this book. In fact, it's pretty much the granddaddy of all the accounting tools we use today. So what is it really? Well, a ledger is just a book that keeps all of a business's transactions organized in their own little sections or accounts. Think of it like a big binder. You've got one page just for tracking your cash, another for all your sales, and maybe a third for the money a specific friend owes you. Everything gets its own dedicated page. A great way to think about it is as the official storybook for a company's money. Every single time money moves, in or out, it gets a new entry in the story. So what you end up with is this complete step-by-step history of where every last cent came from and where it went. Okay, so what does a page in this money storybook actually look like? Let's zoom in a little bit and check out the anatomy of a single account. We're going to build it up piece by piece so you can see how it works. So at its core, every account is basically just a big T that splits the page in two. Super simple. The left side is for something called debits, which we just shortened to DR. Think of this as the inflow side, what's coming in. The right side is for credits, or CR. And yep, you guessed it, that's the outflow side, what's going out. Now, on both sides of that T, the left and the right, you're going to find the exact same four columns. You've got the date of the transaction, something called particulars, which is really just a fancy word for a short description, a folio, which is like a reference number, and of course, the amount. And here's how that all looks when you put it together. See? You've got that simple T shape. You can see the four columns for debits sitting there on the left and the exact same four columns for credits over on the right. This simple, clean format is the engine behind all of accounting. It's powerful stuff. Okay, so we've got the structure down, but how do we know whether to write on the left side or the right side? Well, that's where the golden rules of accounting come into play. And trust me, they are so simple, but they are what makes this whole tool so powerful. Here's rule number 1. Debit the receiver. All this means is that whenever an account receives some kind of value, you write it on the left, on the debit side. So if your cash account gets more money, you debit it. If your equipment account gets a new laptop, you debit that account. The debit side is all about what came in. And rule number 2 is the exact opposite. Credit the giver. So if an account gives some value away, the entry goes on the right side, the credit side. So if you use your cash account to pay a bill, you credit it. The credit side shows what went out. It's that straightforward. So let's lock this in. Debit the receiver and credit the giver. Now, this isn't just a rule. It's the heart of a system called double entry bookkeeping. And what that means is for every single transaction, there are always two entries, a debit in one account and an equal credit in another. The books must always balance. This is the magic that makes the whole system work. All right, enough theory. Let's get our hands dirty and see how this thing actually works in the real world. We're going to take a simple transaction and post it into a ledger account. Now that word, posting, it's just the official term for taking a transaction that you first jotted down somewhere else, maybe in a daily logbook, and then formally moving it into its proper home in the ledger. That's all it is. So let's work through an example. Step 1, we figure out what happened. Let's say cash is received. Simple. Step 2, we apply our golden rule. Okay, which account is receiving something here? The cash account is. And what's our rule for receivers? Debit the receiver. Boom. So we know exactly what to do. We need to make an entry on the debit side of our cash account. And here's what that looks like. Check it out. Right there on the left, the debit side of the cash account, you see that entry for 500 naira. It follows the rule perfectly. The cash account received value, so we debited it. And just so you know, even though we're not showing it here, some other account, like maybe a sales account, would have gotten a matching credit of 500 naira. The books always stay balanced. So, we've talked about what a ledger is, we've taken it apart, and we've even used it. But why bother with all this? Let's tie these basic skills back to why they're so important in the real world. Why does any of this actually matter? Because this super simple system is actually incredibly powerful. It's what lets a shop owner track every single sale and every single expense with perfect clarity. You could use the very same idea to manage your own savings. But the biggest thing? It lets a business answer the most important question of all. After everything's said and done, are we actually making a profit or are we losing money? The ledger gives you the undeniable answer. So look, you now get the fundamental building block of all finance. You've got the structure, you've got the simple rules to track money like a pro. So the last question I have for you is this. If you started a ledger right now, for your own project, your side hustle, or even just for yourself, what kind of story would it tell?